The upcoming Reserve Bank's monetary policy is much awaited for a bunch of reasons. Three big central banks in the world have cut rates and cut rates substantially. The Israeli war is about to escalate and the MPC has three new members. So let's turn to our own experts. CNBC-TV18 Citizens MPC is here for their deliberations. Chairman Pranab Sen and members Sajid Chinoy of JP Morgan, Soumya Ghosh of State Bank, Samran Chakrabarti of Citibank and Sonal Verma of Nomura. Gentlemen and Sonal, as always, thank you very much for joining in. Sajid, I'm going to start with you because of the global backdrop. The Fed has cut more than expected and so has the Chinese PBOC. Won't this prevail on the MPC? To what extent?
I think the global environment is actually far more nuanced than is believed. One would get the impression that with the US labor market slowing and the Fed announcing a 50 basis point cut, that the US is hurtling into recession. But that's not actually the reality on the ground. If you look at the Atlanta Fed, in their estimate, third quarter in the US, July to September, is actually tracking 3%, very far from any recession. And if you look at the internals, both consumption and capital expenditure are holding up. So, in fact, the US resilience story has gotten more support in recent weeks. Now, despite that, we think the Fed will continue cutting because they have more confidence about inflation. And, the Fed's estimate of its neutral rate is somewhere close to 3%. They're currently, even after cutting, they're at 5%. There's a lot of space for the Fed to cut. So you could still be in this Goldilocks situation where the US is resilient and the Fed is cutting and monetary conditions, not just in the US, but around the world are easing because once the Fed moves, many other central banks move. And when monetary conditions ease that much, you're actually buying insurance for 2025 growth. Now, this is not to minimize the near-term risk of a recession. We still think there's about a 35% chance the US slips into recession this year. But if they don't slip into a recession, the Fed easing and the monetary easing around the world actually argues for higher growth next year. Two final points. Good news on crude. This seems more of a supply shock. Crude prices are down into the low 70s, and that's good news for India. And China's stimulus is good, but not good enough. But I think all told, the news at the margin the last few weeks is actually positive from a global growth standpoint.
Well, can we be that sanguine about the crude angle now that there seems to be an escalation? Sonal, until last week, one could be a little more sanguine about the global situation. But with the war escalating, do you think the Reserve Bank has to pencil in more uncertainty and therefore should not ease too soon?
Latha, I think, if we look back at the last 2.5 years, we have had nothing but uncertainty to deal with. And particularly the geopolitical tensions is something we've had like periodic episodes of escalation. And clearly we are in one right now, which is putting an upward pressure on prices. So in terms of how this plays out and the uncertainty is something that we don't know how it's going to play out. That said, I think if you compare where we are today versus where we were back in August, we were actually above $80 per barrel on oil prices. And today, with this geopolitical risk premia being built in, we are basically somewhere around mid-$70 on oil prices. And specifically for India, the oil marketing companies are actually sitting on a large cushion in terms of margins. So in terms of the pass-through to domestic prices actually should not be there. And RBI in its projections has been working with $85 per barrel on Indian basket of oil. So I think we have more than enough cushion. And I think the other angle to look at is also the impact the uncertainty is going to have on investments and growth going forward. So there's also the demand angle to keep in mind. So I think, yes, there is uncertainty, but I think we have enough cushions.
No, I take your point. I'll, time permitting, come to the geopolitical angle again. But Samiran, first let me tackle domestic inflation. After all, the Reserve Bank reiterates it looks at domestic factors. And here, as Sonal points out, $74 is not hell for us. We've seen worse. And what about food? We saw 2 months of food coming down slightly, though not across the board. Will that still be a good reason for RBI to worry?
Looking at it is that the base effect-led decline in inflation is now behind us. Now the base effect will turn adverse. And even if there are no significant new price pressures, we're still going to see 3 inflation prints which are close to 5%, if not more. So that situation could worsen further if we see that this tail end of the monsoon being much stronger than usual, leading to some increase in vegetable prices, and that feeds into things. The second risk to look out for is what we were discussing from oil prices, though maybe not as much of a risk for India because retail prices are unlikely to be hiked anytime soon. And the third is from the China stimulus. If this persists, if China also goes in for a fiscal stimulus on top of the monetary stimulus, then the commodity price increase at a broader level, particularly with respect to metals and all, and gold, that could feed into the inflation forecast as well. So these are some of the upside risks that we have to look at in the short term. However, we are very conscious that whatever exclusion-based core inflation measure one looks at, they're all very benign. So it's not that there is a huge inflationary bias for the overall economy. And RBI needs to make a difficult call between actually waiting to see the inflation prints turn to 4 versus taking a call on their forecast, how forward-looking they're going to be to see that 4% being met on a durable basis. I think that's the critical challenge that one needs to look at.
Point taken. And in that critical challenge, growth appears to be pleading for a bit of softness from policy. Shaumya, would you agree that the August-September numbers on so many things, core sector, IIP, PMI, seem to be indicating that the economy is softened in the second quarter. So will growth be a reason for the Reserve Bank to be dovish?
Yeah, thank you, Latha. I think yes, there is evidence of growth slowing down. If we actually look into the leading indicators, more specifically the consumption-facing sectors in terms of two-wheeler sales, in terms of passenger vehicles, in terms of tractor sales, I think they're all showing signs of a slowdown. And particularly, I think August and September months could see some signs of a slowdown, definitely. And also the fact that if you look into the latest bank credit data, that also saw a significant perceptible slowdown. Even in incremental terms, if I adjust for the merger last year, the total incremental credit growth for like-to-like period till the end of August was actually 2 trillion down from last year. And for the first time in the last 2 years, the gap between the credit and deposit growth is now narrowed down to only 220 basis points. And in fact, on a year-to-date basis, the deposit growth rate is running much higher than the credit growth. So yes, there is evidence of credit growth slowing down. The indicators also showing that there could be some soft patch of data which could come through in the next couple of months. So my sense is that it may not be the time to say that growth is going to slow down because we need to see some more evidences. But one point on the table is clear, given the current geopolitical conflict and the talks of an war getting elongated or getting prolonged or getting broad-based, I think what should be also on the table on the Reserve Bank to address the growth concerns to be the financial stability concerns. So I think overall, the Reserve Bank faces a delicate situation, but for the time being, I think it could still ride through with perhaps a message that there should need to be some sort of an hand-holding in terms of growth, even though the evidence is not clear yet in terms of an perceptible slowdown in growth numbers.
Dr. Sen, if you can combine all these points and also the fact that, what Sonal pointed out, despite the fact that there have been rate cuts, despite the fact that, the US GDP growth is 3%, despite the fact of a fairly elevated escalation of tensions, crude is only $74. I mean, we have seen 80, 90 as recently as April. So it looks like the global growth is not so strong, demand not so strong. Is that an interpretation the RBI has to take both domestically and globally, that growth is not so strong?
Well, no, I mean, the RBI will have to take into account for sure. But the point is, how important is it?
Okay.
If you really look at what effect the global economy has had on the Indian economy, which is really the focus of RBI's action, um, it hasn't made much of a difference. And we've been talking about this for a while now. And all the prognosis that have made don't seem to have been borne out by the developments. So I don't think what is happening globally is going to worry RBI that much. The bigger concern, I think, is what is happening domestically. And there, I think there's a whole bag of mixed signals coming. Shombo just pointed out to a series of data points which tends to indicate a certain degree of softening. But there are other data points which seem to suggest that if nothing else, at least private investment seems to be picking up.
Okay.
So I suspect the RBI is going to be focusing much more on that.
Okay.
Right? And that, to my mind, is really the key issue, that there is a huge amount of uncertainty, global uncertainty for sure, but I think there's greater uncertainty on the domestic front. It doesn't seem to, I don't think any one of us can take a judgment call and say it's going up or it's going down. I mean, it's still moving around, which means that one needs to be flexible.
Okay. Not commit yourself to either side. Okay, on that note, I'm going to take a break. But thereafter, I'm going to ask you all to commit yourselves on what stance the RBI would take, on what they would do to rates and when. Those questions in a minute. Welcome back to the deliberations of CNBC-TV18 Citizens Monetary Policy. I've been speaking with Chairman of our committee, Dr. Pranab Sen, and members Shaumikanti Ghosh, Samiran Chakrabarti, Sajid Chinoy, and Sonal Verma. Gentlemen, and Sonal, thank you for your patience. Sajid, let me come to the stance. Even domestically speaking, domestic impulses, the Reserve Bank has always said that it will be more domestically moved. Here, if you look at the way in which inflation numbers have trended, would you get food inflation, for all that you say, has been coming down from the peak? So do you think that there is a chance of a stance change?
I think the time has come to change stance to neutral, because I think the main reason for not doing that was to get a better grip on food inflation, which has been very sticky over the last year. But the good news is, with every passing week, there's more and more conviction that food inflation is coming down. We've had a very strong monsoon, a good sowing season. The spatial distribution is better. Global food prices have come down. So our sense is food inflation finally is going to soften. And our own estimates are that headline CPI is tracking about 30 basis points below the RBI's forecast, both in the July to September quarter and the October to December quarter. So I think the RBI would have more conviction now that inflation is going to be settling into the low fours in the coming quarters. Now, in addition to that, I think that there are also some high frequency indicators that are slowing. So I think the risks in India, as they have around the world, have become two-sided. And when you have two-sided risks, and of course, you've got the US election risk on November 5th, you want to maintain the optionality. And therefore, I think it's perhaps appropriate to move to a neutral stance now, because you now have the option to respond to these two-sided risks. One final thing I'll say, however, is that even if the RBI does move its stance to neutral, it needs to be careful that that doesn't come across as being too dovish, because the fact is financial conditions have eased meaningfully in India. Bond yields are down 30 basis points. All right. And so it's not that financial conditions are very tight. So I think what the RBI wants to do is buy optionality It wants to move to a neutral stance, to move in any which direction. But until it's ready to cut rates, you want to be a little bit careful in your tone because you don't want to cause easy financial conditions to become even easier, because then that defeats the whole purpose of a neutral stance.
That's the whole point, Sonal. The financial markets, barring the recent pullback because of the escalation in the Middle East, the financial conditions can hardly be considered as tight in India. The way asset inflation has gone, do you think the Reserve Bank should actually go ahead and cut or even go neutral this early?
Latha, short answer, yes, they should. And I think, the thing with financial conditions is we have a flexible inflation targeting mandate. And these supposed easy financial conditions have unfortunately not resulted in stronger growth impulses, whether it's in terms of the discretionary consumption or actually the strength even in the broad-based private capex revival that we've all been waiting for. And it has not led to inflation pressures. So if there are pockets of excess, then you have targeted tools to deal with it. And I think, at some point in time, monetary policy needs to become forward-looking. Just as the last 2 months inflation dipped because of base, the next month or two, the pickup is also because of base effects. And inflation is not going to hit 4 and stay at 4, right? So we'll either be above or below. So you need some other indicators to gauge whether we are aligned to the target. And we've done, a bunch of analysis around that, and that suggests that, 94% of the CPI basket is currently running at 3% inflation. So if the 6% of the basket is leading to volatility but is not leading to any spillovers, if growth momentum indicators, as everyone is pointing out, is already slowing down, and there is a policy induced tightening in credit to specific sectors, and consumption indicators are soft, then there are growth risks, and we know that monetary policy works with long lags. I do think that inflation is aligned to the target, and there are downside risks to growth, particularly relative to the RBI's projections of above 7. So the balance of risk has clearly changed, and we have to become forward-looking. And FY26 CPI is tracking 4%.
No, I'm not arguing against goods inflation. But, data about softness is not one-sided. See, we saw Dabur reporting very poor FMCG sales, but Marico reported very good, high single-digit FMCG volumes. It is a little difficult to come to any steady conclusion on growth. And Samir, and therefore, let me persist with this question. Whether it is US or India, the asset inflation is not something the Reserve Bank can be blind to. Yes, because of the SEBI's announcement of FNO, there has been perhaps some pullback. But the way asset markets are moving, can a central bank cut into this kind of euphoria in stock markets?
So the challenge has been that while RBI has been continuing with this withdrawal of accommodation stance, this withdrawal of accommodation is not resulting in any tightness in the financial conditions index. In fact, by our analysis, the financial conditions have loosened rather than getting tightened. Whether you look at the liquidity side, the short-term rates, or you look at the impulses coming from the equity market or the impulses coming from the FX market, everything has been contributing to this softness in financial conditions. Now, this is somewhat difficult to draw a one-to-one correlation between financial conditions and asset inflation, but literature suggests that there could be a connection. In the Indian context. The series is not long enough to get a very nice academic econometric result out of it. But I would say that the challenge in changing a stance today is that, as Sajid was also referring to, there is a possibility that the market will run ahead of itself and the financial conditions will loosen even further. So it's a delicate balance. If the RBI changes the stance, how does it convey that the stance change is not equivalent to a rate cut? The rate cut is still quite far ahead. If it is
Okay.
effectively able to do it, then a stance change is possible. Otherwise, it's probably better to wait it out. RBI has waited out 19 months.
Yep.
Another couple of months will not make a big difference, according to us.
Fair point. Soumya, the bigger point is, what is the point of a rate cut now? The way banks are chasing deposits, there is still a crunch. So is it a moot question to even ask for a rate cut now?
No, yeah, Lata, I agree with your point. I think the deposit and the credits in the financial system begets a larger issue right now. I think what is happening is that because of this financialization of savings, because of the innovation in the financial system, because of the increasing changes in the payment infrastructure. For example, I'll just give you a simple example is that today, even as the reserve money growth has slowed down, the money supply growth continues to be in double digits thanks to a significant increase in money multiplier because of an lower currency to deposit ratio. So these are all innovations which are happening in the financial system. What in effect it is doing is that it is putting several layers of financial intermediation. So for fund flow now in the financial system, fund is flowing for some say banks to mutual funds. The same fund, mutual fund is now coming back to banks via the TRAPS window, which is in 1 day one, and where the rates are 6.50 to 6.55%. So in effect, that is actually the lower bound to which rates could go in the financial system. And banks typically will not want to lock in papers of longer duration like CDs, CPs, because ultimately they have to go for an asset liability management. So if I take all these factors into consideration, different layers of financial intermediation coming in, different payment infrastructure, innovation, digitization, I think the rates are unlikely to come down in the near future deposit rate, even if suppose the RBI starts to embark on a rate cut cycle. So my sense is that
Point,
as of
Soumya, I have to
now,
cut
I
you
think,
there.
yes.
I have to cut you there because we're running out of time and we have to take the vote. Dr. Sen, just the final point on the November American elections. Do you think the Reserve Bank, you began by saying even earlier that the Reserve Bank should be even toned. Is there another huge uncertainty why the Reserve Bank should not sound dovish or hawkish?
No, in fact, the Reserve Bank should be very, very careful to keep all mention of the global development out of their own policy statement. This is something which we are today in a very dicey situation. We don't know which way the game will go, and it's not good for a body of the stature of the Reserve Bank to take a position overtly. What they do internally is a different matter, whether they take it into account. But that only actually just changes the degree of risk that they face. But I don't think they will actually make...
No, not overtly. I meant that, ahead of such an event, is it better just to remain very, very, neutral and not sound hawkish or dovish? But that's what I meant. Anyway, thank you. We're out of time. We can't belabor this question anymore. Let me ask you all to take your electronic machines and vote. What will the Reserve Bank and the MPC do to rates? Let me start with you, Sajid.
Hold rates, they'll pause.
Hold. Okay, hold. Soumya?
It's
Hold. Okay. Sonal?
They should cut 25 basis point.
Here's the first cut. Samiran?
No change.
3:1, sir, in favor of hold. Dr. Chairman?
Hold.
Hold. Okay, so it's 4:1 in favor of holding the policy. Change of stance. Will the MPC change its stance from the current withdrawal of accommodation? Sajid?
Change to neutral.
Oh, okay. Sonal?
Change to neutral.
Obviously, you voted for a cut. Samiran?
Hold on to the stance,
Hold.
but it's going to be a close call.
Okay. Soumya?
hold on to the stance.
Okay. 2 holds, 2 change to neutral. Dr. Sen?
Change to neutral.
Change to neutral. I think your members are veering to your point of view. Now, the final question, when do you see the first rate cut? Sajid?
We're looking at December.
Okay. Sonal, I think yours is October, right?
Yes.
October. You already said that. Samiran, your first rate cut?
February or April.
Okay. Soumya?
February.
Dr. Sen?
Yeah, I would go with February or April.
Okay, so there you are, the majority expecting the first rate cut only next calendar, but there are at least 2 people dissenting and 1 expecting a cut right away. Makes it a very interesting policy. Thank you very much, members of the Citizens Monetary Policy.